Hello, and welcome to the last day of March 2023 and the last day of the first quarter. It was an insanely busy month, lots to get into, so let's get into it. So rates improved as a whole from around 6.875 to 6.5% over the course of the month. And this happened because of two reasons. And that would be for like a 780 plus FICO score, 95% loan to value, single family residence purchase. So one of those kind of premier buying situations. But rates as a whole improved, and they improved for two reasons. The first reason is we got some rather positive inflation news, which I'm going to be talking about in just a little bit here. The second reason was a general flight to safety. And when I say flight to safety, what I'm talking about is mortgage rates are based on a mortgage-backed securities market. It is a type of bond market. When you get a mortgage, it is a promise to pay. That is a type of bond. Well, bonds are a safer investment than stocks are. And people tend to take their money out of stocks and put it into bonds, a safer investment, when they're concerned. And what would they possibly be concerned about? Well, this month they were concerned about SVB and the fallout from the bank failing. So what happened? In short, there's really two culprits, okay? One is a lack of diversity from inorganic growth. And when I say that, what I'm talking about is kind of a philosophical difference, an intrinsic difference between a bank and a credit union. So credit unions like Elevation's Credit Union, we serve our membership. And for Elevation's Credit Union, it's Colorado residents, okay? People that own or work in Colorado. Those are the members that we serve. We can only grow by serving our membership, by having our members deposit money with Elevation's Credit Union, taking that money and investing it elsewhere. It's what I would call organic growth. It takes a lot of time. Elevations has been around for decades and decades because of that. It takes a long time to grow as a credit union because you don't have the ability to, like a bank could, simply go to Wall Street and raise capital. Hey, we want to start this bank. Please give us money to do so. They're publicly traded. They can receive money from Wall Street and just grow very, very rapidly. And that's what I would call inorganic growth. Well, the advantage of organic growth, like a credit union, is that it's a lot slower process. And slow growth, one of the side effects of it is that we are better suited for high interest rate and low interest rate environments. When interest rates are high, credit unions or banks, they tend to make more money from their deposits. They make more money from the money that's deposited with them, but they're not making as much money on mortgages, business loans, commercial loans, right? So you have one sector picking up the slack of the other sector. When rates are low, they're making very, very little money on those deposits. But what they are doing is they're receiving a lot more money from mortgages, from business loans, from commercial loans. So when high rates and low rates, there's kind of the give and take with regards to the credit union or the bank's ability to generate income. Well, one of the issues with SVB was a lack of diversity. And from that, it was because of inorganic growth. So they were limited to one specific sector, tech startups, and they weren't really diversified in their various income streams. That could be a problem. The second thing that arose with SVB is they made a series of really bad bets. So what happened was when rates were low, they were investing a lot of money into treasuries. When banks or credit unions receive deposit money from members or customers, they take part of it and they set it aside and they keep it liquid and ready available. Let's say 10%, okay? They would take the remaining 90%, let's say, and invest it elsewhere. Well, that's exactly what SVB did. And it's not unique to SVB. Every institution does that. Every institution keeps part of the money on hand and invests the rest of it elsewhere. But what happened with SVB is they invested it in really low interest yielding treasuries. Let's say 2% treasuries, okay? You invest money with the treasury, hold it there, and you're getting paid 2%. Well, when customers start to withdraw money from that institution, they withdraw more than the 10% that the bank held on hand. Now, all of a sudden, a institution is forced to start selling some of those investments. And normally 2% yield is pretty good. It's fire, it's whatever. It's very conservative, but it's very safe. But why would that 2% yield not be worth 2%? Well, a yield may not be worth that 2% if two specific conditions arise. Number one, there's a similar investment elsewhere that's paying a higher yield, i.e. you have treasuries now paying 4%, okay? And two, you're forced to sell that investment. So when you're forced to sell that investment and there's a better investment opportunity elsewhere, all of a sudden your 2% yield is no longer worth 2%. Why would somebody just buy a 2% yield when they could just go across the street and buy a 4% yield with the treasury? That's exactly what happened. So people caught wind that SVB might be in financial straits. they started to withdraw money. They withdrew more than the 10% that the institution held on hand. And now all of a sudden, that institution, SVB, was forced to start selling those treasuries, and they had to sell it at a loss. And they then had to come out and say, we had to sell treasuries at a loss. People heard that, started freaking out, and started withdrawing even more money. It's a little bit of a self-fulfilling prophecy, and it's kind of interesting if you're a money nerd like I am. If you think an institution is going to fail and you start acting like an institution is going to fail and you start to withdraw money like that institution is going to fail, it can in and of itself lead to failure. It's kind of the same way that sometimes when people act like a recession is going to happen, it actually forces a recession to happen. When people hear about a recession, they start to save money, they spend less money. And when you spend less money, other institutions, other corporations start making less money and they start making cuts. And they start to laying off people, their stock prices start to go down, and that can in itself lead to a recession. So it's acting like a recession that can actually lead to a recession. Kind of quirky things, but that's exactly what happened. People caught wind that SVB may not have enough money on hand, started withdrawing even more money, and then you had what they call officially a bank run. Okay, so the good news is the FDIC came out and said, look, we're going to cover all those that had money with them, even if they didn't have those deposits insured. And that turned out to be almost 90% of the total deposits with SVB were not insured deposits. They were above that insurance limit. So that was bad. The FDIC said, like, look, this is going to be a systemic issue if we do not fix it right now. So we got you. We're going to take care of it. We got you covered. Do not worry. First Citizens Bank then ended up coming out and purchasing SVB's assets. Now, other banks have also been mentioned. You heard about First Republic. With First Republic, what happened was other larger banks deposited $30 billion with First Republic to make it so that they did not have that liquidity issue, to make it so that they did not have to start selling those assets, those investments they had made. So the big banks swooped in and deposited money with First Citizens Bank. That fixed their liquidity issue. All of a sudden, First Citizens Bank was kind of in the clear. Credit Suisse, we've heard about Credit Suisse in the news. Well, it came out and UBS said, hey, look, we'll buy Credit Suisse. So there's been kind of a rally from investors, a rally from the FDIC, a rally from other institutions to fix this. Now, this is certainly not going to be the last that we're going to hear about this. It would be very surprising if it was the last time we've heard about this. However, SVB was a canary in a coal mine. And the point of a canary in a coal mine is that you now know the mine is no longer safe. You now know that there's a problem within the mine. So what you're going to probably find, and I'm not talking about Elevation's credit union. We're in a very unique position. We're extremely liquid and very, very sound. We always have been. But what you're probably going to find is a lot of other institutions are probably going to start to change their short-term lending strategy. You might notice them being a little bit slower to do business loans, a little bit slower to do commercial loans, a little bit slower to do home equity loans. Just generally speaking, less quick to lend out money. That could also end up leading to a recession. So again, it's this self-fulfilling prophecy that's kind of playing out. But don't be surprised if you start to hear about banks being a little bit more strict on lending out money. It's because they want to keep more capital on hand. They don't want to end up in an SVB, First Citizens Bank, First Republic situation. So don't be surprised at all if you hear about that. But all of this caused fear in the stock markets. That money flowed into bond markets, which is a safer investment, and it caused mortgage rates to improve, amongst other things. Also of note this month was a very, very interesting Fed meeting. On March 22nd, the Fed met, and they had a really big decision to make because all these Fed rate hikes, and you can see in this graph below, this looks like it should be over a period of many years. This is literally March 17th, 2022 through March 2nd, 22nd of 2023. So drastic Fed rate hikes from 0.5% to 5% today. It's a huge increase in the Fed funds rate. That is what caused all these issues. That's what caused SVB's treasuries to go from being devalued. And when they started selling those assets, they had to sell it at a loss. So the Fed had a big decision to make. Look, we either hike rates, but by doing so, we potentially exacerbate this issue with this bank run, with these bank issues. But it would reassure the markets that, hey, look, it's business as usual. We told you we're going to hike rates by 0.25%, and we are doing that. We are not scared of what's going on with the banks. Or they forego a rate hike. They said, hey, no, we're not going to hike rates. That would give some relief to the banks potentially, but it would spook investors who would say, oh my gosh, you guys are really worried about this bank run issue. You are really worried about banks and financial institutions as a whole. So should we be. So the Fed had this gigantic decision to make. Do we or do we not hike rates? They decided to hike rates by 0.25%, so they followed through with exactly what they said they were going to do. But they changed their language, so they were able to kind of thread that needle. They changed their language from there will be further rate hikes to there may be further tightening. That doesn't seem like a gigantic difference, but in Fed speak, it's a gigantic difference. It's a huge difference. Investors pick apart that Fed meeting press conference and they look for any hint about possible changes in direction. So the Fed saying, look, we might not hike rates again. If you looked at every time they come out with the Fed meeting, they have this what they call dot chart where they say, hey, look, where do you think rates are going to go in the future? And all the voters of the Fed put their opinion out there. Well, when they did that, it looked like it was going to be possibly one additional 0.25% hike. So very mild, but it's less likely now. The Fed changed their language. We're not saying that there's guaranteed to be additional hikes. There might be just simply further tightening. There are other ways that we can curb inflation if we need to. So it seemed like the Fed was able to kind of thread that needle. They did also reassure investors that, hey, look, we think your deposits are safe. We're not really concerned about it. We've seen deposits within institutions become more stable, so people have been less frantic and freaked out about withdrawing money. So it seems like the actions from the FDIC and the other institutions seem to have worked. The Fed seems to have, at least for the time being, thread that needle and reassured investors accordingly. This month, we also received positive inflation data. If you remember my update from last month, there was some very weak inflation data in February. Well, the good news is in March, that improved quite a bit. The consumer price index, which is inflation as you and I feel it, improved from 6.4% to 6%. Significant difference. At one point, that was as high as 9%. So we've already made a third of the way progress for what they're looking for ultimately. Ultimately, they want to get inflation down to around 2%. The producer price index, which is inflation as businesses feel it, so wholesale inflation, what are businesses paying for just raw goods at, that actually improved from 5.7% down to 4.6%. That can be a leading indicator because if inflation comes down for businesses, they tend to start passing that along to consumers via savings. So good news on inflation. Good news on inflation means bonds were very happy. And after all, inflation is the arch nemesis of bonds. So inflation came down, rates improved. There was a flight to safety, rates improved. All in all, it was a really positive month for mortgage rates. Now, one last thing I wanted to point out, because in the news right now, you're hearing a lot of negativity regarding home prices. And it's kind of mind-boggling. So if you looked at home values since 1941, I got this from a subscription service I belong to, which is MBS Highway. Since 1941, there's been 73 years of appreciation with house values, 7 years of depreciation, and 1 year where it was neutral. Like, really, that's insane. That's such a great investment. It's such a stable investment. Also, another thing that's very interesting in this market, in this chart, is when you look at this huge run up in prices, you're like, oh, well, that means that there must have been followed by some negative years. Not necessarily the case. Sometimes after these very positive years, things just kept moving along. Maybe at a slower clip, but they started moving along just fine. So when you look at, we had these gigantic numbers in 2020 and 2021, that doesn't necessarily portend to, hey, we're going to have lower real estate prices going forward. In multiple times, we saw positive, double-digit gains, and it was followed by single-digit gains, double-digit gains, and followed by single-digit gains. So it doesn't necessarily mean that you're going to have lower house prices just because you had a run up in house prices either. And over time, real estate is a crazy solid, safe investment. So I thought that was really interesting. I wanted to share that along as well. All right, so looking ahead to April, a little bit of a quieter month. There is one thing that's going to be very interesting to watch out for. So April 10th, we're going to get updated inflation numbers. We're replacing cooler numbers. So it's very possible that inflation doesn't come down as much as we were hoping for. I would suspect that we're going to get more of a February type of figure with regards to inflation where rates don't necessarily love it. It might look like inflation is a little bit more sticky. But after that, we're set up for several, I think it was 6 consecutive months where we should have very positive inflation progress. So don't worry too much when you hear about, hey, inflation is kind of a little bit more stagnant. It's a little bit more sticky than we were hoping for. It could very well be another blip, kind of like February was. After that, we should be set up for a series of very positive months on the inflation front and making significant progress. As inflation comes down, mortgage rates come down. So I'm cautiously optimistic. I think April might be a little bit of a rough month as a whole for interest rates, but after that, we should see some very good progress. There is no Fed meeting in April. The next Fed meeting is in May. And then lastly, we're going to get the first reading on Q1 GDP, and that's the one piece that I mentioned was going to be very interesting. So technically, a recession is defined as historically, it's defined as 2 consecutive months of negative GDP. Well, it's entirely possible that when we get our first reading of GDP next month, that it's going to be negative. That could very well mean that we're actually already in a recession. The weird thing about a recession is they don't call it until after the fact. You could very well be in a recession and not know that you're in a recession. So keep an eye on that. If it is negative, think you're going to probably hear a lot more talks about recession being more likely, recession being more likely, recession being more likely. It could be entirely possible that we're already in one. Also, last year we had 2 quarters of negative GDP, and they didn't technically call a recession. So there's a little bit of hamstringing that is kind of done with it. Don't stress too much about it. You could already be in a recession and not even know about it, and we don't even know if you're in one until after the fact. So don't stress too much, but also don't be surprised if you start to hear talks of it pick up. So that is it. Thank you all so much, as always, for all your positive feedback. Very much appreciate it. Thank you for all the referrals. It is the lifeblood of our business. We never take it for granted, and we thoroughly appreciate you. So thank you so much. I hope you have a great one. And if you have any other questions, let me know. As you can tell, I kind of live and breathe for this thing. I'm a total nerd when it comes to this stuff, and I absolutely love it. So thank you all so much. I appreciate you. Thank you. Bye.